Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the latest edition of the Investor's Edge. First up, the week in review. Earnings season kicks off with the banks. Well, after some volatility to start the new year, investors have been focused on early earnings reports to give them an indication of where markets may be headed next. The large banks began a parade of quarterly earnings reports with JPMorgan first out of the gate. Despite reporting reasonably strong numbers, shares of JPM actually dropped more than 10% in the 3 days following the earnings release. Now, expectations obviously were pretty high going into the report, and many of the banks, including JPMorgan, were pretty conservative with their loan loss reserves. That may be an indication they could be a little nervous about the credit environment headed into 2022. Now, the financial sector was hot to start the year, even as the growth-oriented sectors like technology sold off. Nevertheless, the S&P Financials sector is now down more than 5% over the last week. I did warn that the road could get rockier as the Fed plans tighter monetary policy to combat the inflationary pressures that are out there. For now, though, it appears that the earnings outlook is simply reinforcing that view. For this week's featured insight, for better or worse. So, one of the most important concepts to understand in the world of finance is the significance of rates of change. Most people think in terms of good or bad. But what really matters is better or worse. Are things getting better or are they getting worse? The most money is actually usually made in the stock market when things go from apocalyptic to just plain awful. Awful is better than apocalyptic. Think back to April of 2020. The market had started to rebound despite COVID lockdowns and chaos. Many investors couldn't understand why the market was rallying with all the bad news. But it was in the process of getting less bad. In other words, better. The world was not going to end. The opposite is also true. Less good is in fact worse. A year ago, JPMorgan's earnings were being revised up by roughly 15%, while now they're only going up by 2 to 3%. Even though going up is good, it is less good, which to the markets is, as you guessed it, bad. Nobody ever said investing was easy. Looking ahead, Fed on deck. Well, our Federal Reserve will be at it once again next week, deciding whether or not to get even more aggressive with their intentions to tighten monetary policy in order to combat inflationary pressures. Recent comments by Fed governors would indicate that they intend to wind down their asset purchase program by March and then proceed to raise interest rates at least 3 times this year, maybe 4. There's also some discussion of letting maturing bonds run off their balance sheet, which would further act to drain liquidity from the financial system. Now, the hawkish turn in sentiment has likely been the primary driver of the recent volatility in equity markets. Next Wednesday will be our first opportunity this year to see whether the Fed's bark is more frightening than its bite. The Fed has been known to change direction rather quickly, like in early 2019 when they did a complete 180 from hiking rates to cutting them, which actually helped the S&P rise more than 30% that year. Buckle up, it could be an exciting ride. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.